Hello and welcome everyone. Thank you for joining our New to Investing webcast today. I am your host, Rachel Deshelle, Head of Technical Research and Strategy for Schwab Center for Financial Research. And I am joined in the chat today by my friend and colleague, Connie Hill. Please feel free to chat in your questions, comments, or requests during the session today. Connie will be in the chat for any questions that I cannot get to. And please give us both a follow on X. I'm Rachel-CS. Connie is Connie Hill CS. And please like and subscribe to our Trader Talks Schwab Coaching YouTube channel, where we have all different types of webcasts over every single topic in trading and investing. So today we are going to start at square one again with our 8-part series. We made some updates and changes to some products, so we are going to kind of start this series over here, really focused on saving versus investing and compounding. So before we do get started, we are going to hit those important disclosures here. So everything that we're going to cover here is for general informational, educational purposes only, should not be considered any type of recommendation or advice. And there are risks associated with investing in dividend paying stocks, including but not limited to the risk that stocks may reduce or stop paying dividends. And Schwab does not recommend the use of technical analysis as a sole means of research. So just to remind you, our series overview, we're starting with the power of starting early today and talking about time being on your side. But these are going to be the next series that we're going to cover in the following weeks. And Alex Coffey is going to be kind of taking over this section for the rest of this series here. So let's just kind of kick it to our agenda. So we've done the series overview. We're going to go through discussing compounding, saving versus investing in depth, hit some important risks of investing as well. And then we're going to talk about some ways to build some different habits when it comes to investing. So let's just talk about what saving is. So we save, we put money away in a savings account. So we're not investing it, we're just kind of tucking cash away to be able to use those funds for like an emergency fund. So we want to make sure we have enough in savings just in case we do have some type of emergency, whether our car breaks down, if we lose our job, things like that. So that's just naturally kind of tucking money away. Now, what we want to do when we invest is we're trying to keep up and exceed the rate of inflation. So inflation is just that sustained increase in prices for goods and services really over time. And what that does is it drags on the purchasing power of your money. So each time, each year that passes, it means each dollar just kind of buys fewer items than it did before. So that's one of the main reasons why people look for towards investing. And so I'm looking at a quote here on our screen from Charles Schwab that says, why be the owner in a company? Well, essentially, it gives you a piece of the action of what the company is doing. For a very small amount of money, you can buy however many shares of a company and have all the benefits of that company growing over all these different time frames. So your investment is essentially going to work for you morning, noon, and night while you go about your profession. And that is a great efficiency you have about investing. So we're going to talk about that all throughout the session today and some of our future sessions as well. So we're kind of getting into why we invest, why we kind of start early, and this is like the rule of compounding. So what I'm going to do here is just kind of talk about how your money can make money on itself and just kind of grow or snowball over time. So we have an example here. We have Maria and Anna. So we have two different bar graphs here. Maria and Anna invested $3,000 every year on January 1st for 10 years. regardless of whether the market was up or down, okay? So they started with the same amount and they did this over a 10-year period. So they didn't have to time the market or anything like that. But what we're keeping in mind is that Maria started 20 years ago. So she had an additional 10 years on her side. Anna started just 10 years ago. And you can see that each invested that total beginning value of $30,000 over that time period. So every 10 years, you had that $3,000 piling up. And if you look at the left side of that graph, you can see Maria had quite a bit more cash that has built up because she was in the market so much longer. So another way that we can kind of look at this is, let's just say that we are starting with $100, okay? And we're going to start there. We're going to start small. And we're going to say that we're going to use the average return of the market annually. And so right now the market's returning about 10% every year. So if you have a 10% return on that money that you've invested, maybe you're looking at investing in one of the major indexes, and let's just say like the S&P 500, maybe you're doing an S&P 500 fund, and you're assuming a 10% annualized return over time. So that doesn't necessarily mean that you're going to have a 10% return every year. Of course, nothing's guaranteed, but at average over time, that's what the market has shown. And so over the first year, let's just say this is year 0, you will have essentially $110, okay? So in year 1, let's just say this is year 1, we're going to multiply that by another 10%. And this is going to yield a value of 121. So by year 2, your investment will be $121. Okay. Now, if we take that by another 10% here, that gives us, by year 3, this gives us an amount of $133. Okay. And so if you look at this amount that you started with, $100 on year 0, and by the start of year 3, you had $133, keep in mind that your investment grew 10% over each of those years. You actually have a 33% return. So that extra 3%, instead of just adding the 10% up to 30, that extra 3% comes from compounding. So that's just how your money can snowball over time and work for you. And so that's essentially what compounding looks like. So you have the time on your side. And I want to actually go back to one more concept. So you don't have to start big. The main thing that you want to do is just start. You want to start as early as you can, even if you're starting small. And one of the most famous people out there, one of our most famous investors, Warren Buffett, you know how he is one of the world's wealthiest men and one of the greatest investors. He didn't start big. He actually started with only $74 and started investing then at the age of 11. So think if you're using babysitting money or lemonade stand money or however you collect a little cash here and there. If you are a younger investor, maybe you're an older new investor and you are just kind of starting out, it makes sense to just start small. Even Warren Buffett did it, and look where he is today. He started early, and it was the power of compounding that was on his side. So that's kind of the difference between saving and investing. We'll dive into a little bit more of investing now, since we covered a little bit of compounding. We'll revisit that at the end as well, but I want to talk about what a stock is. So we have a stock. It represents partial ownership of a company. So when you own shares of stock, you're owning that very small fraction of the company, and you own a claim on the company's future earnings. So you can make money in the stock market in 2 different ways. Main ways would be stock appreciation. So if you buy a stock when the price is 10 and you sell it when it's 20, that's how you can make money in stock appreciation. And then there's also a dividend payment. So this is more income oriented. And this is where a company pays that periodic payment, usually it's quarterly, of corporate profits. So a couple different ways there. Now, let's kind of focus on some of the risks associated with stock investing. So, number one, we're starting with market risk. So, this is just kind of like systematic risks or systemic risk, I should say, across the market. So, these are due to factors like economic downturns. You may have changes in interest rates from the Fed, geopolitical instability, and wars and things like that, or even fluctuations in commodity prices. So some of the things that we have seen here recently, this type of market risk really cannot be eliminated through diversification at all. But there's also company specific risks. So these are risks that affect a particular company by itself, and this can be eliminated through diversification. We'll talk about diversification in some of the other sections, but this is going to affect the operations of the company. So you have poor management decisions that may happen. You may have labor strikes, product recalls, or bankruptcy. So all these different things that affect the risk of the company. Then you have a couple other things that run at a deeper level. So you have financial risk, and so that's more of the around the company's financials. So you're looking at their capital structure and their ability to manage some of the debt, and so it's really looking at how stable their cash flow structure is. So this is focused on like credit risk or liquidity risk and some of the changes in interest rates and currency rates as well that may affect a company's financial structure. Now, we'll also talk about sector and industry risk. So, when we think about, let's say, healthcare or energy or technology, financials, or real estate, those are specific sectors. Now, you can get into the nitty gritty of like oil and gas or semiconductors or things like that that are more industry specific. And so, this is the risk that a specific sector or industry may underperform due to some things like regulatory updates, technological disruptions, or changing consumer demand here. Now, we've covered some of the main risks with investing because when we talk about the benefits, we always have to talk about the risks. So now that we've covered that, let's kind of gear our way back towards our compounding. And we're going to kind of talk about some of the mistakes that break your compounding of interest, and they some mistakes that may kind of reset your clock as far as your time on the in the market. So one of the things that we kind of want to focus on, which we'll talk about through many different sessions here, is really just keeping the focus on our long-term view. So especially if you are a younger investor, we want to avoid any type of emotional decisions or panic selling when we see a big red day in the markets, or we see fear on some of our media outlets, or we see something on social media that talks about the next market downturn. We want to avoid a lot of the emotions that come with that. Again, we'll focus more on that in another session and just kind of help you build some habits there. But this is one of the major mistakes that breaks compounding and resets your investing clock. Because if you panic sell, it is very difficult to time your entry back into the market. So I've seen this with clients that I've worked with. Some of them never got back into the market after the great financial crisis. Some of them never got back in after the 2022 bear market. So the market tends to go up over time. Obviously, there has been bear markets. There has been periods of times where the market has gone nowhere, but over time, over the long term, if you do have a long time horizon, especially if you're a younger or newer investor, this panic selling will definitely be a big mistake here. So another one that we're going to talk about is chasing getting rich quick schemes. There is going to be a lot of different information out there, especially on social media. You're going to see TikToks, Instagram Reels, maybe things on Snapchat, things on X that will kind of show you different ways or try to lure you in chasing some of these get rich quick schemes. And that breaks your compounding as well, because typically these are a pump and dump type of scheme where you could put yourself at risk of losing more than you expected, or taking additional risks that you wouldn't normally take. So we're going to again talk about that in a later session as well to avoid that. This one kind of goes right along with it. I kind of mentioned this as well, but just taking excessive risks. So putting all your eggs into one basket, something like that. So maybe having too much of one particular stock and not diversifying your investments enough. Or if you are placing, maybe when you're building out your portfolio, only putting stocks in one particular sector, things like that. Those are taking excessive risks because you are essentially concentrated. So it makes you more prone to like those company specific risks or sector risks that we just talked about. And then the last one would be pulling money out frequently. So if you're frequently selling your investments to pay for a bike, to pay for a car, or to put a down payment on a house, whatever it may be. I know those are kind of like bigger events and things like that, but if you're constantly placing sell orders in your account and taking the cash out of your account, rather than putting the cash into your account to put to work into the market, that is going to break your compounding, because you won't have as much money that you started with to invest if you're going to continuously pull it out. So those are some of the mistakes that we want to avoid. Again, we will cover some of those in our later classes. And then let's see if we have any questions in the chat. Let's see. Okay, so Gary said, watch out for those WhatsApp groups and scams. Yes, there are so many scam artists out there. Me and some of the other coaches have noticed this ourselves. You'll see imposters out there on X. I want to make sure we are aware of this as well, because you will see that some imposters will use our name or will use our pictures, and they may post to join a WhatsApp for investing strategies or something like that. Thank you, Gary, for calling that out, because that is a huge thing to be aware of. We want to make sure we avoid those at all costs, because we as coaches will never sell you anything or ask you to join a WhatsApp or a chat group. So keep in mind that's a great one too. And then Kevin, you said my son shows this class to his high school students and has them do a portfolio. Well, Kevin, first, that's really sweet. And then yeah, thank you. You touched on a really great point. So if you guys have children, if you have grandchildren, even if you have a friend, a colleague, someone that is new to investing, you haven't spoke about investing with, and you may want to get them involved into the market to have some financial freedom, meet some of their goals, financial goals as well. Definitely share this class series with them. Me and the other coaches are definitely happy to help you guys get started and answer some of those questions. So thanks, guys, for putting that in the chat there. The last thing we're going to go through today is some habit building, okay? So we are going to start talking about the habits that you can start with investing. And the number one habit is to start now. We talked about Warren Buffett and how he started at the very not so ripe age of 11, but he only started with $74. He started small and he started early. So even if you are starting later on in life, start now. Okay, even if you're a younger investor, start now, even if you only have $5 to your name. You'll thank yourself later. Your older self will thank yourself later. Now, the other one is invest consistently. Okay, so some folks look at dollar cost averaging and things like that, which we'll talk about in another in another session, but just like with any habit, you want to be consistent. So you don't see results after going to the gym just one time. You see that over weeks and months. So you have to get into that habit of investing consistently. So whether that is $5 or $10 a week, or that is $100 a month, $500 a month, whatever it is, there is definitely ways to invest consistently. So we will talk about more of that. And then we're going to talk about just avoiding extreme risks. So this is just not putting all your eggs into one basket, not in any one particular um, company, particular sector, things like that. So only working with your available cash, things like that, just as you're getting started. So as we round out this session, I want to check the chat one more time to see if we have any other questions. Silvermine said, very true. My father forced me to start investing when I got my first real job at 18. I bet you are thanking your father now for getting you started. I know my dad talked to me about getting started at the age of 19. So I that's when I started investing as well. So I can kind of relate to some of you younger investors that may be starting this process. And I would say these are the best habits. These are the mistakes to keep in mind that we want to avoid. So I just want to thank you guys all for your questions. I have one last one that popped through about an ETF. We cannot recommend specific ETFs, but we will talk about exchange traded funds in a couple of these next sessions as well. So definitely stay tuned. These are going to be Thursdays at 4 p.m. Alex Coffey is going to teach the remaining sessions here. I want to mention Connie, thank you for helping us out in the chat here. Please give us both a follow on X, Connie Hill CS, Rachel-CS, and please like this video if you found it useful, and please subscribe to us on Trader Talk Schwab Coaching. Thank you again, and see you later, new investors.